Okay. Good morning, good evening, one and all. I, Priya Dugar, on behalf of Professional Development Committee of Institute of Chartered Accountants of India, would like to request the Abhay Charger, Chairman, Professional Development Committee, to please give the welcome address.
Thank you, Priya, and good evening to all the esteemed participants who've joined from all over the country on this 17th webinar, which we have organizing for last 1 year, Discover New Avenues. And today's topic again is a very interesting topic with our esteemed faculty who's here, young faculty, but with so much experience and doing so well in this particular sector. CA Manas Chok. So thank you, Manas, for your time you've given to us, and I'm sure you'll share your experience and you'll tell the participants that this is an area which could be looked at. And especially, I would talk about FEMA and international taxation compliance. So, how this could be an emerging opportunities accountants on today's session and discussion with, I'm sure our faculty would be speaking on this. And Manas, thank you for being here among all of us. And also with me is, as always, Piyush Chajirji from Mumbai, the Vice Chairman of Professional Development Committee. Piyush bhai, out of your extensive travel, you've made yourself available. Thank you so much for being here. And we are very eagerly waiting to hear Manas, because this topic is really interesting. Why? Because like being the chairman of WTO last year, where a lot of outsourcing opportunities were there, and then commercial law committee, which takes care of FEMA and international taxation. A lot of compliances which we have seen over the years, which now is coming to India. A lot of work which is coming to India, cross-border activities. If I talk overseas investments, foreign remittances, import exports transactions, international payments. We talk about 15 CB, which the members are issuing. So a lot of compliance services, a lot of opportunities, which is now coming to us. And I think today, if the expert will be sharing his knowledge, the area which we should be focused by participants, and I'm sure this would really be a real discover new avenues for professional growth of chartered accountants. So once again, Manas, thank you so much. And quickly on the PDC as a chairman, so a lot of initiative myself and Piyush bhai have been taking, and especially in areas where we talk about new avenues, we are looking for some areas which to be focused on the insurance sector. We are penetrating on the public provident fund. Again, it's an area where we've had a detailed discussion on certain areas with NABARD, certain sectors, which of course been done by chartered accountants for years, more particularly with respect to the state cooperative and district cooperative banks, and also the primary agriculture cooperative societies. So there has been a detailed discussion, and certainly something, or I would say a new area of opportunity, which certainly will be coming to all of us very soon across the country, because it's not each state currently is dominated with cooperative. But of course, even where the states are not dominated, there also the cooperative is playing a very important role. And a Ministry of Corporation also insists that an organized, standardized, and a uniform practice should be followed, whether it's a finance, whether it's accounting, manuals, any such area, which we had a detailed discussion a couple of days back, and other areas on farmer producers organizations. And of course, multi-purpose empanelment form is already live. I request members who have not filled this form. So this year, we've added some sectors where you have experience, or any other sector which you have an experience. We are collating the data, because this will become then a strong validated data for every regulator, authorities, institutions, which we can submit from ICI, because now there are a lot of inquiries which is coming to us to share the panel of chartered accountants in certain specific areas. So I sincerely request participants to fill whatever experience they possess for last number of years in a separate section, which has been added this year, so that this data becomes an authentic and valid data which could be circulated. And lastly, of course, the members, I'm sure we'll have a good interaction. We'll have Q&A, which will be raised, and they'll be, would be answered by Manas, the domain expert. And I'm sure this 1.5 hours, 2 hours would be an excellent interaction, learning, discussion, and would be a new area of opportunity. So I encourage all the participants to explore this area as a specialized domain for professional practice going forward. And after this session, once again, welcome all of you. And thank you, Manas, for giving you valuable time. And I'm sure you'll share your experience and definitely would become an opportunity for all of us. Thank you.
Thank you so much, sir. Now I request CA Piyush Charger, sir, to give the opening remarks for the session.
Thank you so much, Priya. First of all, my chairman, CA Vai Chajaji, uh, then the speaker for the day, CA Manas Chu, and all the participants, esteemed members of the Institute, ladies and gentlemen. Very good afternoon to all of you. And I welcome you to the 17th series of this particular council year, wherein, of course, we are trying to discover new avenues. And when I talk about FEMA and international taxation, I know my chairman is very much fond of, because he was a chairman of global and WTO trade also. And he has done a lot of certificate courses on FEMA also when he was the chairman of commercial economic laws also. And therefore, this topic has been always very close to his heart. And I'm sure when Manas would be able to do a justice to his expectation over there, when you are able to tell the members what are the new opportunities or the new areas wherein the practice in FEMA can be done. And my personal experience has been, Manas, I believe a lot of notices are now been issued. Earlier, FEMA was not being looked in by the government also very seriously, but I think so Enforcement Directorate, which actually manages or administers the FEMA law, has become quite active nowadays. And maybe 10 years, 15 years old matters wherein you have not complied with certain compliances which are required to be done in FEMA, they are issuing notices. So I think so it's at a very apt time the chairman and the team has decided for this topic, and I think so nobody else could be better than you to choose this topics, because I know your background, wherein you are very strong as far as FEMA is concerned. And I'm sure all the questions which will be raised by the participants before you end of the session, I'm sure you will be able to answer them to best of your expectations, best of your ability to that extent. Of course, as far as PDC, Abebe is doing a wonderful job under his chairmanship. He's making us run everywhere. His only idea has been to create more and more opportunities for the profession. That's what that interest is. So please do look into it. I would just like to touch upon and add to what my chairman has said, just to remind you that MEF is getting over on 29th of August. So if you have not filled up your forms, please do not wait for the last moment of your time. Please do fill it as soon as possible. We have almost 3 or 4 days left. Today is 26 or 27, 28 and 29. Please do not seek extensions for that also probably. But if any issues comes up, I'm sure the chairman and myself, whole committee would stand for you. I think so we have received a lot of queries also from the members, whereby the data which is automatically coming from an SSP portal to our MEF portal, probably there are mismatches, and those all emails have been already compiled by our secretariat team. And I think so each and every query would be resolved. So wherever there are genuine issues are there, I think so you will be get solved. And all the updated data would be available on the MEF portal to my best of my knowledge. And I think so you should not face a problem to it. I would in fact congratulate my chairman. His dream of completing this MEF process in the month of August, which is almost 4 or 5 months before. Generally, we do it in month of December and January. Would be this time, should be over, hopefully, to the best of the members, whatever they require before 31st of August, everything should be fine. So my best wishes to all of you. I hope this MEF, once you fill up, it will serve the panel which has been finalized by the institute, as rightly mentioned by the chairman sir also, would form a place for the various institutions. Various institutions would be referring to this panel. It's not only for the bank branch audit today, as he rightly mentioned earlier also, that we are sharing this panel with a lot of other institutions whenever they seek from us. Sometimes it's a state institution, sometimes it's a central government, or maybe any other institution for that matter. So it's very important to it. So please be attentive on this lecture. I'm sure it would be very useful for you. And most importantly, I'm sure, Manasji, if you can also cover some sort of how to deal with ED, Enforcement Directorate, because I know a lot of chartered accountants are not practicing in these areas. They are very good at income tax representations, they are good at GST representations, but probably they are not appearing before Enforcement Directorate when it comes to FEMA, when it comes to PMLA. I know my chairman has made a lot of effort when he was the chairman of commercial, economic and other laws. But I think so still more effort is required. And I think so we need to make our members comfortable. The way they appear before the income tax, they should appear before an enforcement directorate, and not only lawyers should be seen over there. That's what I feel. And therefore, this 2-hour session would actually be a serve as a नींव जो बोलते हैं नींव create करेगा. So you can definitely take it forward. But I know, if I'm not wrong, Manasji, most of our enforcement directors are nothing but they are transferred from income tax department only. So they are same those IRS officers who were deputy commissioner, joint commissioner. The name may sound enforcement directorate, but they are IRS officers ultimately, wherein you would have infracted during your assessment proceedings. So I think so it would be all fine. So thank you very much once again. Thank you, Chairman sir. Thank you very much, Manasji. Over to you. Priya. Yes.
Thank you so much, sir. Thank you so much. Sir, I would like you to start with the session, and I'll keep asking questions as in how you're comfortable in between the session, after the session, whatever is suitable. So
In
you can
between
just
also we
let
can
me know.
discuss on all the any
Right.
specific questions
You
that
can start
come
with the topics, and whenever you
Right.
feel like, you can just let me know. I'll ask you the question, whatever has been received from the members.
For sure. Okay.
Yeah.
So good afternoon, everyone. First of all, I want to thank the committee, the chair and the vice chair, Abhiji and Piyushji, for inviting me and giving me this opportunity to discuss on a very important topic, that is the FEMA and the international tax. As both the chair and the vice chair has actually explained, it's a topic which is holding a very important essence in the today's scenario, where the government is also coming up with different specific schemes like FCNRB, where the government also wants different kind of foreign exchange reserve and wants to increase the foreign exchange reserves, with which the major specific law that comes into picture is FEMA as well as the international tax. So I highly appreciate the efforts done by the committee with the leadership of Chairman Abhiji and Piyushji. With their expertise, with their knowledge, with their vast experience, this committee is doing an extraordinary job, specifically coming up and conceptualizing the specific DNA of coming up with new specific avenues for the chartered accountants, like one topic that we'll be discussing. Apart from it, multiple topics with which the Indian CAs can actually render services here, and not just limiting themselves with the traditional services like audit or tax. So with this, now I would want to start the specific session. So if anyone has any specific questions, you can just mention during the session itself. I'll try to clear it during the session. Otherwise, we'll make sure that your specific question is answered at the last. So I hope my screen is visible to all.
Yes,
Starting
sir.
with starting with the transaction, like because of today's specific discussion is pertaining to transactions that are cross-border transactions. So it is not just limiting to capital account or current account. So we'll be giving an overall, like I'll be specifically deliberating on the overall aspect of it and how the specific FEMA as well as the international tax comes into picture, and specifically because the objective of the PDC is the Professional Development Committee is to see how chartered accountants comes into picture into rendering these services and specifically give advice into this specific laws. And also QC has also mentioned on the enforcement director. Definitely I'll be taking this specific topic on the enforcement director, because what I have also practically seen majorly in the enforcement directorate, majority are the lawyers. So here also there is huge opportunity for the chartered accountants, which I'll make sure I'll be covering this part also in the future slides. So starting with the transaction, if I talk about on the international or from the cross-border front, majorly five types of laws and procedural things comes into picture, starting with the FEMA Act. FEMA Act, it's a very important act covering the regulatory part of the international transaction. So there are two, from the angle of the international transaction or the cross-border transaction, there are two specific part that we have to discuss. One is the regulatory angle, the other is the revenue angle. Revenue angle means where there is a specific revenue for the government of India. So revenue angle is majorly from the angle of, if I talk about from the angle of current account transaction, so it is the Customs Act, then the GST Act. So these are the transactions where the revenue is the part of the entire transaction. The second part is on the regulatory angle. So regulatory angle is how the government is actually regulating the entire international transactions. So FEMA is one part of the specific act which governs the international transaction. Other acts, are there multiple acts, specifically if I talk about from the current account angle, they are FTDRA Act, that is Foreign Trade Development and Regulation Act. Apart from it, there is SEZ Act, that is Special Economic Zone 2005. Next, there are multiple acts specifically product wise. So for example, for telecommunication, there's a different act. For example, for different products, like for example, for IT, there are specific restrictions to it. So for different products, there are category wise or product wise, there are different acts which governs. In addition to it, like for example, there is quality norms into it, like BIS. So multiple products now have, the government has notified that you require a BIS certificate, then only you can import or manufacture that product. So from the current account angle, that is the normal business transaction. So apart from FEMA is one part of it. The other, there are multiplicity of acts. So when you are advising clients from the current account angle, you have to actually have the holistic view on different acts, specifically the product specific act also. Next, from the angle of, if I talk about from the angle of a capital account transaction, so capital account transaction majority is only with the coverage is with the FEMA Act. So FEMA Act is the majority of the coverage is like when we have classified the transaction as a capital account transaction. So the FEMA Act plays a very important role. In addition to it, the Income Tax Act. So Income Tax Act, which that is the now the Income Tax Act 2025. It is it is also from the angle of revenue, like because here the government revenue is there. So how whenever there is a remittance from India to outside India, or opposite, when for example there is a remittance into India, how the Income Tax Act comes into picture. For example, if I talk about from the capital account transaction, there is overseas investment. So for example, Indian company is planning to make investment outside India. So what all things apart from the FEMA you have to also see from the angle of income tax. In addition to it, there is transfer pricing. Transfer pricing also part of the income tax, where there is a related party transaction. I will be discussing in detail on each and every part. Plus GST and customs, which I've already discussed from the current account angle. If there is a current account transaction, then you have to evaluate on the angle of the revenue, because here the objective of the government is to fetch the revenue from the importer or the exporter. So how the customs acts comes into picture, we will be discussing in detail on specifically different acts. Next is the accounting, because accounting is the bed is basically it's in the DNA of the chartered accountants. So how here also the accounting part, that is on the disclosure, foreign exchange, recognitions, because once we have recognized our specific transaction, then we have to also see on the disclosures, then we have to also see on the foreign exchange, on the conversion of the foreign exchange, how it has to be reported. So all this, specifically all the five angles have to be seen. Then we are able to actually analyze and judge the entire international transaction. So from the opportunity angle, like how if I basically start and initiate this specific topic, the first and foremost thing is the classification of the transaction. This is the very important part. So my discussion, my today's discussion will not be very technical on each and every part, like because for example, if I talk about on the FDI, so FDI in itself, it's a 2 to 3 hour session. Like ODI, similarly, it is a 2 to 3 hour session. So I will not cover each and every topic in detail, but what I will be giving it to you as in the next 1.5 hours will be a broad coverage about each and every topic. Why? Because each and every topic has, because ultimately if you know a broad framework of the topic, then it will be easy for you to actually understand where your specifically interest lies. Basis that you can also go and deep dive into the regulatory part of, or basically the nitty-gritties of that specific act. So in the next 1.5 hours, I will be giving a broad picture of the specific laws, the transactions, plus how or where the the chartered accountant's role comes into picture on the certification side, on the advisory side, on the structuring side. So that will be the major discussion I will be having in the next 1.5 hours. So first, starting with it, on the first part is the classification. So what exactly classification is? So classification is a very important part. Classification can be in, for example, first is on the residence side. So resident side means, so first and foremost thing is, if I talk from the FEMA angle and the income tax angle, the resident definition is different. So we have to see from what angle you are actually classifying, or from what angle you want to see the transaction, from the income tax angle, from the FEMA angle. So if I talk about from the FEMA angle, if you have classified that it is a resident individual, Then in that case, you have to see the account type. Account type means whether it is a current account transaction or a capital account transaction. Current account and capital account transaction classification is very much important because all your specific laws, all your specific regulations is dependent on this specific part, that is the account type. Then is the instrument. For example, if you have classified your transaction as a capital account transaction, then you have to see whether it is a ECB, whether it is FDI, or there is very thin line between a difference between the FDI and the FCRA. So where your specific transaction falls into, so as an instrument, then basis that you have to determine your regulatory lane, basically on which specific act, on which specific master direction, on which specific rules or regulations you have to actually see. Then is the structuring. Structuring is, it's a very important like a specific topic where CAs can come into picture, that is a structuring. So structuring is because pricing, end use, maturity, treaty positions, all are these important because, like for example, if I talk about FDI doesn't generally have an end use. Like if for example, a particular company in India is receiving FDI into India, so it doesn't generally have a end use. But if we talk about that Indian company is receiving ECB, that is external commercial borrowings, then ECB has an end use. So you have to see basis your instrument what exactly specific regulatory structure you have to follow. Next is the certification, because there are multiple certifications that is there from the FEMA angle. From earlier it was ECB Form 2 that you have to file monthly, but now it has been it has been withdrawn. But there are multiple specific forms like Form FC where an auditor has to sign. In case it is an individual, then a C has to sign. Then here it's because the government has given us the power as a chartered accountant to sign that specific document. So this is a very big opportunity for us. Next is the reporting, because reporting, it's a very important part, how the government will get to know how this company is performing if they have received an FDI or DI. So here is the reporting. It can be an annual reporting, it can be monthly reporting. Next is the remediate. Remediate is basically where there is a delay in filing. So if there is a delay in filing of any of the forms, so first part is the penalty or the late submission fees. Late submission fees is in the FEMA Act. So late submission fees. So late submission fee also has a specific time frame. If it is crossing that time frame, then in that case, you have to go for compounding. So remediation is basically if, for example, there is any delay, or if, for example, you have contravened any FEMA Act or any act, then you can go for remediation. Next is the basically products. Product-wise basically is converting the whole entire knowledge into a repeated advisory services. So now we will be first starting the session on the FEMA. Later, and the second part we'll be discussing on the income tax, that is the international tax. So because I will be discussing on the broader framework, if anyone has any specific, if anyone wants me to cover any specific topic, or if anyone wants me to slow down any speed or slow down any specific topic, just mention in the chat box. I'll make sure that your specific, either the query or your topic is very well covered in this next 1.5 hours. So now we'll be starting with the FEMA. So FEMA, that is the Foreign Exchange Management Act. FEMA Act was introduced in 1999. Before the FEMA Act, it was FERA, that is Foreign Exchange Regulation Act. The objective, because as the name is, as you can see from the name, earlier it was Foreign Exchange Regulation, now it is Foreign Exchange Management. So earlier objective was regulating the entire foreign exchange, because India was not in a good position. Their foreign exchange was depleting. As everyone know, in 1991 and 1992, what happened? We didn't have a foreign exchange, like our foreign exchange reserves were like hardly for 3 weeks. So it was a big challenge for the Indian government. So that is why, because that too, we are on a developing stage. We are not a developed country as of yet. So it's a big challenge for the Indian government that they have to maintain their foreign exchange reserves, because they have certain kind of obligations, like they have taken multiple loans, like foreign exchange loans. So they have to give them like the principal amount as well as the interest, they have to give that. So their Indian government has the responsibility to maintain the foreign exchange reserves. But because being a developing country, India in itself I won't say complete shortage, but there is a shortage of the capital. Like you will see all on the news everywhere that India in itself has a multiple capital options. But if I talk about from the angle of manufacturing, hardcore manufacturing, there are still challenges from the capital angle, because Indian itself doesn't have that specific like capital that they can deploy from the like, because it's a long-term game. So deployment of the capital also, it's a very big challenge. So here, because government objective is to make sure that the foreign exchange reserves are like not depleting, are actually growing. So that is where there are certain specific acts which they actually introduced, and one of which was FAIR Act, that is Foreign Exchange Regulation Act. But because India had to liberalize, because that is what they committed in 1992, that they will be liberalizing their whole industrial policy, foreign exchange laws. So with that objective only, they liberalized the foreign exchange regulation, and they came up with the Foreign Exchange Management Act 1999. It was notified in 2000, but it was introduced in 1999. So as it is regulation to management, here the objective is only to manage the foreign exchange. But if I see from the angle of just the name, it is not just a name change. There are multiple liberalization in the act and the laws. If you will see from the angle of earlier, entire multiple, like maximum sectors were under the restricted, like under the approval route. Now 99% of the sectors are under the automatic route. So with that objective, the government has come up with that objective of liberalization, but still there are multiple challenges. When you are dealing actually practically with the banks, with the RBI, it is not that simple. There are still challenges. If you are going forward with the approval route, there's still multiple challenges, and because there are challenges, that is why chartered accountant roles comes into picture. If it would have been a single straightforward transaction, then now in the age of AI, it's very easy. But because there are challenges, because there are complexities, that is why chartered accountants can have a very big role here. So Foreign Exchange Management Act, it's a very small act. If you will read the act, you will say that this small act has a very big impact. How come? Because it's a only 49 section act. It's only 49 sections are there in this specific act. So if you have to understand in detail about the Foreign Exchange Management Act, you don't have to actually just understand the act. Apart from the act, there are rules, regulations, and directions. So for individual transaction, if I talk about from the angle of FDI, so there's a specific there is a specific rule on the FDI. If I talk about from the ECB, that is external commercial borrowing, there's a specific rule on ECB. If I talk about from the overseas investment, so there is a specific rule on overseas investment rules. So for individual transactions, there are specific rules. So who frames the rules? The central government has the power to frame the rules. So central government has the power to frame the rules. So what exactly is meant by central government? Central government means the Ministry of Finance. So Ministry of Finance has the power to frame the rules for under the FEMA Act. Next is the regulations. So regulations are basically how these rule has to be regulated. So here, who has been given the power? The power lies with the RBI. Next is the directions. So directions are basically the RBI is giving directions to the AD bank. AD bank means authorized dealer banks. So RBI is giving the directions to the authorized dealers. So first is the rules, then regulations, then directions. So what do you have to, if you want to analyze or understand the FEMA Act, first you have to read the Act. Act is very small, so you won't be getting a deep understanding about individual transactions. So Act generally is only prescribing the definitions, the prohibitions, the powers, the penalties. That is what the Act is mentioning, but it is giving the power to the central government to frame the rules. So framing the rules, after, if you want to read any specific transaction, you have to read the specific rules. After the rules, you have to read the regulations and then the directions. So now, because if, for example, because I have to not just focus on a person who have a like practical understanding of the law, I will give a broad understanding. So that is why if a particular person who wants to start reading the Act, it will be difficult for him to read the rule, then regulations, and directions. They will be facing difficult challenges when understanding that. So for them, what you can start with it is reading the master directions. So what exactly is the master directions? Master directions are, it is basically the RBI has like summarized the entire rules, regulations, and the directions. It is not like they summarized the law. They have actually mentioned all the important aspect of the rules, regulations, and the directions in the master directions. So master direction, if someone wants to start reading the law, so they can start with the master directions. Master directions is also transaction wise. For example, if for the FDI there's a different master direction, for ODI it is different, for ECB it is different. So for all the different transactions, there are specific different master directions. So if you want to start understanding from the basics, then master direction should be your first step, because that will give a broad picture of how the specific transaction will be governed. Basis, when you have got the basic understanding, then you have to read the rules, regulations, and directions, and have and also see what other practical aspect is there from the compounding cases, from different investigations cases, or from different case laws. So first part from the FEMA that I was also discussing in before was the residency. So the residency, it's a very important specific definition, and as I mentioned, it is different from the income tax. So why residency is different? Why residency is important? Because on the basis of the resident, on the basis of the residency, the entire transaction has to be defined whether it will be permissible or not. Second, what is the limit to it? Because for resident individual, there is a different limit. For a person resident outside India, it is a different limit. So first thing is you have to define the residency of the particular person or the company. So residency, if I talk about from the FEMA angle, the first and the basic foundation is 182 days, similar to the income tax. Like if a person is residing for more than 182 days in the preceding financial year, then he will be called as a resident individual, that is a person resident in India. But there are certain kind of caveats or certain kind of exceptions. So what are the exceptions? So first exception is if, for example, an Indian person who was there in the preceding financial year for more than 182 days, he was there, but in this specific financial year, he thought of moving to Dubai for employment purpose. So the day he is leaving from India to Dubai for employment purpose, from that day itself, he will be treated as a person resident outside India, regardless of whatever his stay is in the previous financial year. Regardless of that, if he is moving outside India for three specific purposes, like first is the employment, second is business or vocation, third, a very important part where the ambiguity is, that is the intention. So intention to stay outside India for uncertain period. Here, if a person intention is to stay outside India for uncertain period, so the day they are leaving from India to outside India, from that day itself, they will be treated as person resident outside India. Opposite is the case if a person is coming into India for employment, business vocation, or for intention to stay for an uncertain period. Then in that case, he will be treated as a person resident in India from the day he reaches to India. So here, simply, it is not passport driven. It is not only from the angle of how many days he is staying in India. His intent is also very important, because as I mentioned, his intention to stay for intention to stay for outside India is for uncertain period. He doesn't know like he will be staying outside India for how much time. So that is why the intention is very important. In case of income tax, there is no condition on the intention. It is just as an act. It mentions on the timelines on specific days. There is no condition on the intention, but FEMA Act works on the intention. So it is very important to understand the intention of the person if he is moving outside India. So there was a specific, very important part that was there for example, a person who is going outside India as a student. If, for example, a person is going outside India to study MBA in Harvard University. So here, because maybe the Harvard University course is only for 2 years, will he be treated as a person resident outside India or person resident in India? So here the RBI has given an FAQ, and it mentions that because that student is going outside India, even if for education, and that education time frame is only for 2 years, but generally it is seen that if a person is going outside India for education, there is highly possibility that he will not come back to India immediately. He will be working there. So his intention to stay outside India is his intention to stay outside India is for uncertain period. You don't know that his intention is only for 2 years or maybe 4 years. So it's uncertain. So that is why the RBI has come up with an FAQ. If a student is going outside India, then he will be treated as a person resident outside India. So it's a very important core test to understand whether he's a person resident in India or a person resident outside India. Basis that, you have to see which specific law or regulations you have to follow. Second and very important part, in case of income tax, for a single financial year, a person residentialship is single. That is, if he is treated as a person resident in India, it is for the entire financial year. But in case of FEMA, it is not the case, because the person who is living outside India, for example, for employment purpose, so the day he is leaving, he will be treated as a person resident outside India. So, for example, it is today is, for example, 26th of August. So if a person is leaving outside India for employment on 26th of August, so from 26th of August, he will be treated as a person resident outside India. But before 26th of August, from 1st April to 26th of August, he will be treated as a person resident in India. So here, in a particular financial year, there can be multiple residentialship status. It is not like it is limited to only one, like in income tax, there can be multiple resident status. So as a CA, as a chartered accountant, it is very much important for you to actually take the evidence for the intention, evidence for the time or the date. So basis that, you have to determine the residential status of that particular person. Next, and a very important part, first we have to understand the residential status. Next, we have to understand the account type. So account type, as I have mentioned, the entire FEMA Act has been defined into two specific accounts. One is the current account, the second is the capital account. So current account transactions, I'll first describe and define the capital account transaction. So what exactly is the capital account transaction? Capital account transaction, if I go with the basics, it says that any transaction which alters assets or the liabilities. If it is altering the asset or liability, then in that case, it is a capital account transaction. But opposite is the case for the current account. What exactly is the current account? Current account means if it is not a capital account transaction, then it will be a current account transaction. So a normal business account transaction like import and export transaction, so that will be treated as like a donation, like a gift. It will be treated as a current account transaction. So FEMA section 2J describes the current account transaction. Section 5 determines the permissibility of the current account. Section 2E of the FEMA Act define the capital account transaction. Section 6 define the permissibility of the capital account transaction. So if I talk about from the broad framework or the regulatory part from the capital account, the current account, current capital account transactions are generally prohibited until and unless it is permitted. So what does it mean? I'll repeat it again. I'll repeat the line again. It says capital account transactions are generally prohibited until and unless it is permitted. It means if the FEMA Act clearly mentions that this specific transaction is allowed, then only it is allowed. Otherwise, it will be treated as it is not allowed. Opposite is the case with the current account. What exactly is meant by current account? Current account means, because it is a business transaction, the government doesn't want to have a strong hold, compliance, or scrutiny of that transaction. So that is why it is generally permitted until and unless it is prohibited. So all the current account transactions is generally permitted until and unless it is prohibited. So even if it is not mentioned in the law that it is specifically permitted, it will be treated as it is permitted until and unless it is specifically mentioned in the law that this specific transaction is not allowed or prohibited. Then only that current account transaction is not allowed. So this is the broad framework of the current account and the capital account transaction. So like as I've given the example, current account is import, consultancy fees, royalty, travel, education, maintenance. In case of capital account, it is equity, debt, guarantee, property, deposits. So first thing, we have to understand the residential status. After that, we have to understand the account, like whether it is a current account transaction or the capital account transaction. So basis that, you have to actually determine what specific rule or regulations you have to follow. So I will be first starting with the capital account transaction, that is the inbound investments. So I will, as I mentioned, because we have a short time of only 2 hours, so I will be discussing the broad framework. Like I have individual slides only for individual transaction, but if anyone wants me to cover any specific topic in detail, definitely I will cover that. So I will start with the capital account transaction, and capital account transaction, that too first with the inbound investments. So what exactly is the inbound investment? So inbound investments means all your foreign direct investment. It is a very important part, very important role. It is a FDI plays a very important role for the government of India. Maybe you might have read in the news also that India's net FDI is actually negative or zero. Net FDI means FDI minus the ODI. So FDI minus ODI is actually net as a zero or negative. So here, because FDI plays a very important role in the manufacturing, in the service industry, in the investment part, that is the like the stock market or different AIFs and different areas of investments. So it is a very important role. It plays a very important role. So because it plays a very important role, earlier FDI generally was prohibited or under the approval route for majority of the sectors, because the government doesn't want to open their entire sector on the day one, because it's a developing country. They want to have a strong hold for sectors where the employment is the major area, like for example textile, garments, like food processing, agriculture sectors, defense sector because it's a strategic sector, insurance. So these are sectors where the government initially had an apprehension that they don't want to open this sector because it's a developing stage. If a foreign investor comes into India, they will be having a complete strategic role, complete strategic control, and basis that they will be enjoying the entire economic framework of India. So earlier the thought process was not to open the entire economy, but now as in today, if I talk about 99.9 specific sectors are under the automatic route. So automatic route. So before, like if I talk about on the automatic route, so there are all the FDI transactions have been divided into three parts. One is the automatic route. So second is the approval route. Third is the prohibited sectors. Automatic route, as I mentioned, 99% sectors are another automatic route. So what exactly is meant by automatic route? Automatic route means that you don't have to take the permission from the government of India before making the investments. This means you have to comply with the FEMA Act. This means that you have to comply with all the laws, but it means that you don't have to take the permission from the government of India before making the investment. Permission means you don't have to actually take an approval from them before making the investment. You just have to intimate to the government. You just have to intimate through different forms. You have to do just follow the specific rules and regulations, and you are okay with it. So 99% sectors are under the automatic route. If I talk about all the sectors that you can think of, majority are under the automatic route. Second is the approval route. So approval route are the sectors where government still wants to have a control. So approval route, if I talk about, defense is under the approval route. Earlier insurance was under the approval route, but now the government has opened up. Agriculture is still under the approval route. So the few sectors where the government still wants to have a control, because it can be like print media is under the approval route, because print can have a very important can impact this national security, sovereignty also. So print media it's under the approval route. So there are few sectors where still the government think not because we are developing countries, but because they want to have a from the angle of security, they have decided on the few sectors where they don't want to open as on today also. So that these sectors are called as approval route sectors. So for the approval route sector, if you have specific sectors under the approval route, and it's a very big area for chartered accountants, because here you have to represent the entire case to the government. So how this whole approval routes function, I will be discussing in detail on the sectors where discussing on the topics where CAs can play a good role. So approval route is a very important area where chartered accountants can come into picture. Because if it is under automatic route, then you have to just fill the form, and it's not a very big task. So that is why it is not a very, I won't say remunerative. So where actually a permission is required, where a certain approval is required, that is where your intellectual knowledge, your expertise comes into picture. So approval route, how this whole system works. So earlier there was a specific portal called as FIFP. Now they have changed to national single window. So you have to apply in the national single window. National single window, actually, it's the application goes to the DPIIT. Then DPIIT sends that application to the concerned ministry. Concerned ministry will have apprehensions, will discuss your case. You have to represent your case to the concerned ministry. And after that, they are satisfied, yes, that your company is genuine. There will be no security threat. There will be no impact. then that specific ministry gives the NOC, and the DPIIT again give us the approval. So approval route functions like you have to apply the application to the DPIIT. DPIIT is just a coordination ministry. It is not basically gives the final approval. So it takes an it sends an application to the concerned ministry, and the concerned ministry sends back the application maybe with the deficiency, maybe with certain questions. Once they are satisfied, they give the NOC. After their NOC, then DPIIT gives you the final approval. So there, it is, if I'd say, this is a very big area, but it is a time-taking process. It is not like you get the approval within 1 to 2 months. It may take 6 months, 1 year time for the approval, because all depends upon the sector, the company that is planning to make an investment in, what is the background, the KYC, security challenge, the multiplicity of things that you have to see when it is under the approval route. And in addition to it, there was a specific PN3 which mentioned that if any investment is coming into India from a country which is sharing land borders like China, China, Sri Lanka, Bangladesh, Pakistan, or all the land bordering nations, if any investment is coming into India, like Hong Kong also, so in that case, it will be treated as under the approval route, regardless of the sector. Even if you are dealing in accounting sector also, that is also under the approval route. So if any investment is coming into India from a land bordering nation, then it will be treated as under the approval route. Here, the approval, if you are similarly, you have to apply an application to the DPIIT. DPIIT sends the application to the MHA. So all this application of the land bordering nations goes to the MHA. Once the MHA is satisfied, then they give you the NOC. So I have practically seen in because this is a 3 to 4 years back that the government has come up with this specific public notice. So there actually, it took for certain sectors, for 2-3 years there wasn't any movement. So last month itself, the government has liberalized the thought process. They have identified certain strategic sectors like electronic, mobile phone manufacturing, electrical. So they've identified few sectors where they want investments. So where they want the investments, they have liberalized the approach. They have given a specific time frame that within this time frame they will be giving you the reward, either with the positive or the negative, but within the time frame itself they will work. Earlier there wasn't any time frame. They will take their specific time. They will take substantial time to give a specific approval. So it's a very big area where chartered accountants can come into picture. Next is the prohibition sector. Prohibited sectors where the foreign company cannot invest into India. First is the real estate, the lottery business, nidhi funds. So few of the sectors which are in the prohibited sectors where you cannot make investment into India. Next is the instruments. So if I talk about from the instruments, first and major part on the instrument, majority of the companies issues the equity shares. So plain vanilla equity shares. So plain vanilla equity shares are majority of the transactions. So in the equity shares, they are not much of challenge because everything is streamlined. You have to also see from the Companies Act angle also. So everything is streamlined. In addition to it, certain companies are also now raising, like startups are also raising CCPs, that is compulsory convertible preference shares and compulsory convertible debentures. So if it is compulsory convertible preferences and debentures, then only it will be treated as a equity instrument. Otherwise, if it is not compulsory, it is optionally convertible preference shares or optionally convertible debentures, then you have to read the law of external commercial borrowings. If it is compulsory convertible, then only equity specifically regulations you have to study. Next is the pricing. So what exactly is the pricing? Pricing is basically at what value that specific transaction will be undertaken. What value means there is a specific pricing guidelines. So if, for example, a foreign company wants to make an investment into India, so at what value that investment can be done? And that is also specifically defined under the FEMA Act. So what exactly does the FEMA Act mention on the pricing guidelines? It clearly mentions, if I give you a broad understanding of it, it clearly mentions that a person who is resident outside India should not be given any kind of advantage in comparison to the person who is resident in India. I'll brief it again. A person resident outside India will not be or should not be given any kind of advantage over and above over the person who is resident in India. So this is a broad framework of the pricing guidelines. So for example, if I talk about a person who is resident in India, he is transferring his shares to a person resident outside India. Here, what it says that because a share is transferred from India to outside India, the money will flow into India eventually. So it says the share value should not be less than the value determined by the registered valuer or the merchant banker. So objective is that ultimately, if the money is coming into India, the Indian government, Indian country should not be at a disadvantaged position. So here, if the transfer is from person resident in India to person resident outside India, then clear cut, the value should not be less than the fair value defined by the registered value or the merchant banker. So earlier, they were in case because earlier here cost accountant, chartered accountant, and merchant banker was mentioned. But because you have to also comply with the Companies Act, so the Companies Act straightaway says if any valuation has to be done, then it has to be through the registered valuer. So there shouldn't be any multiplicity of the valuation report. So what you can do is you can directly get the valuation report from a registered valuer, and that you can use for the FEMA Act also. So valuation is a very important part. Next is the date. On what date you have to determine the valuation, that is also very important. So this is the pricing regulations. Next is the method. So how exactly the methods you have to, how the valuation of the shares to be done. So valuation of the shares, there is no specific method the RBI or the FEMA Act defines. It doesn't define that you have to do the like DCF method, net asset method, or any specific method. It doesn't define any specific method. What it says as per the specifically internationally accepted price. So when a registered valuer or a merchant banker will be giving a report, that is a valuation report, what you have to do is you have to make sure that you have to give a valid justification and why you are actually following that specific method, why you are following the DCF method, why you are following the net asset method. So whatever is the reason of following any particular method, give a brief justification to it that why you are following that method. FEMA Act doesn't restrict you to actually use any specific method for any specific company or country or any transaction. You can use any method basis the best whatever the registered value or the merchant banker feels. Next is the reporting. Reporting, a very important part, because reporting is where generally chartered accountants comes into picture. So reporting angle is basically what forms of filing have to be done. So first and important filing is the form FCGPR. Form FCGPR has to be filed at the initial day, that is the date on which you will be receiving the investments. So that is the Indian company when they will be receiving the investment, basis that you have to file the form FCGPR. FCGPR defines who is the Indian company, who is the foreign company, how much shareholding will be there. Every important information about the transaction has to be mentioned in the form FCGPR. Next is form FCTRS. FCTRS is basically when there is a transfer of shares from a person resident outside India to a person resident in India, or opposite, person resident in India to a person resident outside India, then form FCTRS has to be filed. Next is the annual FLA, that is the foreign liability and assets. So it's an annual form that has to be filed, that is the form FLA. The timeline for the form FLA is 15th of July, but form FLA has to be on the basis of the audited financials. So multiple companies, like majority of the private companies, they're not able to sign or finalize their accounts before the 15th of July. So what advantage that the RBI has given? RBI has mentioned that you, on the basis of the draft financials, you can file the form FLA. Once your audited financials are ready, it is audited, then you have to revise your form FLA. So annual FLA, you have to first file on the basis of your draft. If it is not finalized before the 15th of July, if it is finalized, then well and good. If it is not, you can file on the basis of draft. After that, you have to file on the basis of the audited. Even if there is like multiple changes and also a huge change in the amount, it doesn't matter. Just make sure you have filed that FLA before the 15th of July and file the final FLA on the basis of the audited financials. If there is any kind of delay in filing form FLA, then there is a specific clause on the LSF, that is late submission fees. If there is a delay in filing of the form FLA, FCGPR, then you have to file the form, then you have to pay a LSF, that is late submission fees. So if any specific questions anyone has on the FDI, you can just mention in the chat box, and I would request the team if there's any question on the FDI. Otherwise, I'll move to the next part, that is the ODI.
Sure, just let me check it. So, for FDI, right?
Yes, yes.
So one of the participant is asking, what are the critical FEMA consideration in relation to the FDI into India, particularly from the perspective of transaction structuring and regulatory reporting?
So as I mentioned, because FDI, I've given a broad picture to it, but there are other specific, because I mentioned, because FDI in itself, it is a 3-hour session. And if I talk about from the certification course, which the institute also has, a single day covers only the FDI. So it will be difficult to cover the entire part, but I've given a broad picture on how the FDI functions. But there are multiple parts on the FDI. If I give you a broad understanding, they are downstream investment rules, also how actually the pricing actually functions, if there is any specific approval route, how this approval route actually functions, what all things you have to take into picture, what or how the representation has to be done. Because CA, because being a professional, you have to make sure that your representation is strong. Basis that only you will be given the actual approval. So all of this, because of the paucity, I won't be able to cover, but majority of the part on the FDI I've actually covered. If any specific point that you want me to cover, definitely I'll cover. Like there are sector
So
specific
on
rules like,
FDI only,
yes, yes, tell me, ma'am.
only this was the question on FDI.
Okay, no worries. So
No other
if I
types.
talk about on the sector specific also, like e-commerce, it's a very regulated sector. Like for example, cash and carry sector. These are like inventory model of e-commerce, like marketplace based model. There was a recent change only like 2 weeks back. The government has liberalized this specific approach. So there are sector specific rules and regulations also when you are advising clients. Next is on the, this is basically the FDI compliance lifestyle. That is filing of the FCGPR, then if there is a transfer, then FCTRS. If there is a downstream investment, then it's a form of DI. If there is ESOP, then form ESOP. Convertible notes, then form CN. Then outstanding FDI at the end of the year, then it is on the FLA. So this is basically the timeline also I mentioned. I will be sharing across my PPT also after the end of the session. You can also go through that in detail. So it covers the FCGPR within 30 days from the date of issue, FCTRS within 60 days from the date of transfer, from DI within 30 days of the allotment, ESOP is 30 days, FLA is 15th of July. So these are basically timelines that you have to strictly follow, because if there is any delay, then you have to actually bear the consequences of late submission fees. I won't say there will be a big kind of penalty, but definitely you have to pay a late submission fees. Next is the ODI. So ODI, if I talk about earlier, it is inbound transaction. Now I'm talking about the overseas investment transaction. So ODI transaction actually, it is a very the specific law, the rule on the ODI was recently changed. And recently, I won't say very recent, but it was changed in 2022. So in 2022, the government, the central government, that is the Ministry of Finance, came out with foreign exchange management overseas investment rules, foreign exchange management overseas investment regulations, and foreign exchange management overseas investment directions. So on the same day itself, on 22nd of August, they came out with 3 specific rules, regulations, and the directions covering the entire, like the encompassing the entire overseas investments. So the entire overseas investment will be, if you want to study, you can study from this specific 3 parts. So what exactly is on the ODI? So ODI, first important thing is the category of the transaction, whether it is a ODI, it is a OPI, or it is a debt. So like similar, I have not covered the FDI and the FPI. Let me discuss that part also, ODI and the OPI. What it says ODI, there is a specific difference between ODI and OPI. What it says, like ODI is basically from the strategic angle, you are making an investment on the long-term perspective. OPI is you're making investment in listed securities outside India for a short-term profit, for just an increase in share price. That is a short-term gain and loss that you want to have. That is part of the OPI. ODI is that you're making investment from the strategic angle, that you want to have a long-term investment. And on the long-term investment, you will be getting gains like dividends, royalty, and different other ways of getting the return from that specific investment. So there, the ODI, the specific rules and regulations define the definition of ODI and OPI. What ODI definition says that if a company is making an investment outside India in an unlisted company, then it will be treated as a ODI. If it is making investment into unlisted company, then ODI. If it is making investment into listed company, but with more than 10% shareholding, then ODI. If it is making investment in a listed space, but with less than 10%, then OPI. So above 10% ODI, below 10% OPI. Unlisted company, ODI. So this is the broad understanding. Same understanding functions with FDI and FPI. Why this category? Because for the ODI, for the FDI, the regulations are stringent. For FPI and for OPI, the regulations are on the liberalized angle because the reporting are less. In case of equity, that is FDI, we only understood the equity part. On the debt part, there is specific rules, that is the ECB, that is external commercial borrowings. But here in the case of overseas investment, it is not the case. Even if it is equity, even if it is debt, compulsory convertible, optionally convertible, any guarantee, anything, everything is covered under the ODI. So all your financial commitments, either equity, debt, guarantee, non-financial commitments, everything is covered under the overseas investment rules and regulations. But in the FDI, it is not the case. Only the equity is covered under the FDI. All your debt structures are covered under the ECB guidelines. So this is the category. Second is the limit. So what exactly is the limit? The limit has been defined. It is not an annual limit. It is a total limit. Total limit means how much an Indian company can make an investment outside India. So the financial commitment is basically how much a financial commitment can be done by an Indian company outside India. So the limit is 400% of the net worth. So 4 times the net worth is a maximum amount the Indian company can make an investment outside India. As I mentioned, investment means equity, debt, non-fund guarantee, any kind of investment or capital commitment is part of this. So entire financial commitment can be maximum 4%, 4 times of the net worth. So it is not specifically limited to a single. For example, there is an Indian company, he has set up a unit in Australia. Now he wants to set up a unit in Dubai. So your cumulative limit is 4 times the net worth. It is not limited to any specific country. The cumulative limit is 4 times the net worth. So you have to see as a CA, when an Indian company is making investment outside India, you have to actually see whether it is coming under the limit of 4 times the net worth. So if I talk about the specific form that you have to file, that is the form FC, I will be discussing in detail the form FC, which you have to file in the initial stage itself when you are making investment outside India. Form FC Part E has to be filed by the auditor, not the chartered accountant, but the statutory auditor of the company. The stat auditor of the company has to sign the form FC. And if it is an individual, because the individual doesn't have an auditor, so for them, it can be any specific independent chartered accountant. So in general sense, if it is a company and company making investment, then in that case, it is auditor. Otherwise, if it is an individual, then in that case, it will be any independent chartered accountant. So form FC Part E covers this specific clause called as the how much the investment the company has made before, and whether that specific limit is below the limit of 4 times the net worth. That is what you have to certify as a chartered accountant. So you have to certify the net worth. You have to certify the financial commitment already done before the financial commitment you are currently doing. Plus, third thing that you have to certify is the total, whether it is below the 4 times the net worth limit or not. So these 3 things majorly you have to certify as a chartered accountant in the form FC. Apart from it, all the form FC part A to D has to be filed by the company, has to be signed by this company. But as chartered accountant, you have to, because your entire role will be to handhold the entire overseas investment. So you have to fill the entire form FC. But as a chartered accountant, you have to just sign the form FC part E. So, and next is, because we have understood from the form FC. Next is, as I was explaining, in case of overseas investment, all your overseas investment, either equity, debt, everything is covered under the overseas investment rules and regulations. You don't have to study anything else apart from this specific rules and regulations. So when so as I mentioned, 4 times the net worth is encompassing the entire equity, debt, and guarantee. So you have to see as a CA that it is below that specific limit. Next thing is the control. So what exactly is the control? Control has also been defined. And why it has been defined? Because if an Indian company has a control outside India, has a control in the foreign entity, then in that case, there will be further conditions, further regulations that you have to follow. If, for example, there is a unlisted company outside India and the investment is less than 10%. So obviously, even if it is an ODI transaction, the government wants that because you don't have a control outside India, so you will be liberalized in certain 1 or 2 aspects, not all the aspect of ODI, but in certain 1 or 2 aspects of the overseas investment transaction. So that is where control has also been specifically defined under the overseas investment rules. Next, the debt. Debt, a very important change in the debt that has come into picture is they have changed the definition. Earlier, the overseas investment rule mentioned that if an Indian company has made an equity investment in a foreign company, only to that company, the company can lend a loan. I'll repeat it again. If you want to give a debt, if you want to lend a loan, if you want to lend money outside India to a foreign company, you can do it only when you have a foreign investment in that company. That was the earlier specific rule. But now what they have changed, they have changed that if the Indian company has a control in that foreign company, then only the debt can be given. So what they have said, if there's a control, then only debt. Earlier it was the case that if there is an equity, then debt. But now if there is a control, then debt. So only this important condition is there. Apart from it, if because it's an equity, already an equity is already there, then only you can give the debt. So it's a related party transaction. So you have to see from the transfer pricing angle how much interest rate that you have to charge. Next is the guarantee. Guarantee can be corporate guarantee, bank back, promoter guarantees, or any kind of guarantees which can be given. So on the reporting angle, there are specifically forms that have to be filed. First is the form FC, as I've already explained. When it has to be in before or at the time of making the financial commitment, the form FC has to be filed, and the form FC has to be filed through the AD bank. It is not like you have to file to the RBI. It has to be filed through the AD bank. So all the documents and everything has to be submitted to the AD bank. Next, after filing of the form FC, the RBI will be the bank will be giving to you UIN, that is unique identification number. So all your future investment into that company, you have to mention that specific UIN. So form FC objective is that your UIN will be generated. After that, once an investment is done, so within 6 months time frame, you have to get the evidence of the investment. So a share certificate or certain documents has to be you have to provide to the bank that you have made the investment. Next is the APR. APR is similar to FLA that we have studied in the FDI. Here it is APR, that is annual performance report. So what exactly is the annual performance report? Like FLA talks about on the Indian performance, APR talks about on the foreign company's performance. So how the foreign company has performed. So all your investments, so whatever investment that you have made outside India, you have to file the APR. I'm mentioning about all the companies that you have made the investments. So APR has to be filed every year. So what is the timeline for the APR? APR timeline is 31st of December. So before 31st of December, you have to file the form APR. Next, on what basis the APR has to be filed? APR has to be filed on the basis of the audited financials of the overseas company. That is the overseas company's audited financials. On the basis of that, you have to file the form APR. Another question, if for example, the foreign company, like Dubai company, doesn't need to have an audit because there's a specific threshold limit below which you don't require an audit. So if the foreign company doesn't have a requirement of audit, how will I file the form APR? The law straightforward says that APR has to be filed on the basis of the audited financials of the overseas company. So when the law was new, multiple like companies, what they did was they got the signing of or basically the audit of the overseas company by an Indian chartered accountant. So Indian CA generally signed as a special purpose audit, and basis that special purpose audit, they used to file the form APR. But now multiple banks have it is not actually there's still ambiguity involved, but multiple banks have started insisting that even if there is no requirement of annual audit of the foreign company, you have to get it done because APR has to be filed on the basis of the annual audit report. So annual auditing or annual audit of the foreign company. So it's a big challenge because I would say there's still ambiguities because certain banks are accepting the Indian chartered accountant special purpose audit also, but some banks are specifically mentioning that only after getting that specific audit by the foreign company, then only we'll accept your form APR. So we have to see. Like you have to discuss with the AD bank basis that you have to define on what approach you have to follow. Next is the repatriation. Repatriation is basically there is disinvestment, dividend, fees, liquidation, whatever amount is due to the Indian company, you have to repatriate it within the specific time frame. Next is the remediation. Remediation is basically if you're not following any kind of specific law, if there is a delay in any filing of the specific form, then you have to go for remediation. Remediation, if for example there is a delay in filing of the form FC, if delay in filing form APR, then you have to file the late submission fees. So late submission fees also has certain conditions. There are specific the LSF. In case of LSF, the RBI has clearly defined and how the LSF has to be calculated. So the condition for the LSF is that if the delay in reporting is within the 3 years, then only you can go forward with the LSF. That means if a reporting delays up to 3 years, then you can move forward with the LSF. If it is crossing the 3 years, then it is mandatory for you to move forward with the application to the compounding. That you have to get that offense compounded. Then only your specific form will be accepted. So if it is within 3 years, form FC, form APR, FLA, anything within 3 years, pay LSF, you are allowed. But if it is beyond 3 years, you have to get your specific offense compounded by the RBI. So any questions from the ODI angle? Anyone? If anyone anyone has, then otherwise I'll move to the next part, that is the ECB.
Just give me a second. There is one question. What are the major compliance requirements for the ODI, and what role can a chartered accountant play in ensuring end-to-end compliance?
So as I mentioned, sir, the compliance first start with the understanding of the regulation. Like if you have the understanding of the regulation, then you have to understand the specific forms that you have to comply. So first form is the form FC. As I mentioned, form FC is the starting part of the overseas investment. So you have to file the form FC. Form FC is when you are undertaking the financial commitment, you have to file the form FC. On the basis of the form FC, the RBI will generate a UIN, that is unique identification number. So all your investments, for the investments into that company, you have to mention the unique identification number of what is generated initially. After that, within the 6 months time frame, you have to give the evidence of the investment. So you have to give the equity certificate, like a share certificate to the AD bank. If it is a loan transaction, then you have to give a loan specific agreement to the AD bank. After that, you have to file an APR, form APR each and every year. In addition to it, if there is any liquidation, if there is any liquidation or if there is any disinvestment, then also there is a single form called as form FC only. It is not like there are multiple forms, only single form, that is form FC is there. So in case of form FC, there are multiple sections. So one section is disinvestment. So disinvestment part you have to actually comply and file it with. Any other question, ma'am?
There is one question. If the valuation is done by a merchant banker based on an internationally accepted price methodology, is it mandatory to include the words on arm's length basis in the valuation report?
Yes, if I talk about if you're making a foreign investment, or maybe like for example, if it is in overseas investment, so if the investment is actually already been done, there is further investment that has to be done. You have to actually see that it is on the arm's length basis. So the overseas, if I talk about the overseas investment regulation, what they have done is they completely changed the entire framework of the pricing. Earlier, they used to mention there was before 2022, the condition was if it is below $5 million, then a CA can do. If it is above $5 million, then a merchant banker can only do. But now what they have done, they have said that the pricing, the valuation has to be done basis the international accepted pricing methodology, plus it has to be on the arm's length basis. So arm's length basis have to actually be been defined in the merchant banker or the valuation report. It is mandatory because it is clearly cut mentioned in the overseas investment rules now.
There is one more question. Can an unlisted Indian economy under OPI route invest in shares of foreign listed shares, debentures, bonds, etc.?
No, a very important question. Because of the paucity, I'm not able to cover all the transaction, but definitely because you've asked this question, what the broad framework says on the OPI, the Indian unlisted company cannot make an overseas portfolio investment. That means if there is an Indian company, like for example ABC Private Limited, ABC Private Limited cannot invest into a foreign listed company. They cannot move forward with an application of OPI. So it is clear cut that Indian listed company cannot move forward to the OPI transaction. They can only do a ODI transaction. Listed company is allowed. Listed company is allowed that to up to 50% of their net worth. But unlisted company not allowed. About Indian resident individual, it is allowed up to the limit of LRS.
Okay, so the other person is asking whether investment in foreign branch will be covered in ODI
Yes.
and 400% NW at each point to be insured in ODI.
As I mentioned, it is cumulatively, like if we have made 5 investments, so cumulative investment limit is 4 times of the net worth. So it is cumulative. So for each and every investment, when an Indian company is making the investment, as a CA, as an auditor, you have to certify that it is below the limit of 4 times the net worth. So it is for every transaction you have to actually see, but make sure it is cumulative. It is not like country wise you have to see 4 times the net worth.
So as for now, only these were the questions.
Okay,
You
so
can just
now
go
because
ahead.
we are left with 45 minutes and I have a lot of topics to cover, so now we will be discussing on the ECB. So ECB also, last year itself, the government has changed and overhauled the entire ECB framework. So ECB is basically if your transaction, the ECB is inbound, if an Indian company wants to have a borrowing from outside India. Here, the Indian company wants to have a borrowing from outside India. So here, because it is a borrowing by the Indian company, it is called as external. External means from outside India, commercial borrowings. So external commercial borrowings, if it is a borrowing, it is a debt, then only you have to follow the ECB regulations and rules. Why there is separate distinction between ECB and the FDI? Because FDI, there is no end use. In case of ECB, they are end use. In case of loan, there is end use which the government has defined, like if for what purpose the loan is there. Basis the purpose of the loan, there will be a definite, they have defined that what will be the tenure of the loan. It can be 3 years, 5 years, 7 years, basis the definition, basis the purpose of the loan. And they can be they are in the end use also, they have mentioned that it can be general corporate purpose. So for if it is general corporate purpose, so they have defined the specific time in which you have to repay back that specific loan. So ECB framework majorly covers from the first the eligible borrowers. Who can be the eligible borrowers who can actually take the loan from outside India? Second is permitted currency and the form of borrowing. That means in what currency, in what foreign currency the loan can be done. Next is the minimum average maturity period. That means within how much time the loan has to be repaid back. So for example, I'm taking a loan from Indian bank and the loan period is for 7 years. So it means after 7 years, you have to within 7 years, like in the time frame of 7 years, you have to repay back that loan. But minimum average maturity period is not calculated like that. So there's a specific formula. So there is a specific formula in the FEMA Act, in the ECB rules, which defines that how the minimum average maturity period has to be calculated. But minimum average maturity period objective is that what should be the minimum time frame for which you are taking the specific loan. Next is the all-in cost. All-in cost means the entire cost of the loan. So that means the loan, the interest amount, the processing, the maybe different kind of fees that is involved in the loan. Everything is included as an all-in cost. So there is a ceiling on the all-in cost, that how much the all-in cost, how much interest can be maximum charged from the Indian company when they are raising the external commercial borrowings. Next is the negative list. The negative list means the sectors which are under the prohibited sectors. That means they cannot raise money in that specific sector, like real estate is a sector which cannot raise the external commercial borrowings. Then the security, can it be an unsecured loan or can be a secure loan? Like what the guarantee has to be done, if any hedging, because certain specific loan requirement also has hedging, that you have to get your loan hedged, because because the loan tenure is for 7 years or 10 years. So because as you know, the Indian rupees is generally depreciating. So after maybe 10 years, the loan, the Indian rupees is 150, like $1 is 150 rupees or 200 rupees. So it can be a big challenge for the Indian company, that they want to not only just give the principal, not generally just give the interest, but also the principal. The principal after 10 years will be a huge burden. So that is why hedging requirement is there for certain specific type of transactions. So next is the specific compliances. First is the form ECB. That is the form ECB that you have to file. This is the primary document, first primary form basis in which you have to define who is taking the loan, what is the amount, what is the all-in cost, what is the purpose. Everything you have to define in the form ECB. Basis the filing of the form ECB, you are eligible to draw that specific loan. After that, you have to report the form ECB2. Earlier, every month you had to file the ECB2, but now they have changed. Now you don't have to file the ECB2 every month. Only in case of change in any kind of borrowings, then only you have to file and report in the form ECB2. That is, a change is there, then only you have to file the ECB2. If there is a closure, then repayment, conversion, refinancing, everything also has to be defined under the form ECB2. So these are basically the three type of capital account transaction, that is FDI, ODI, and the ECB. Next is the trade transactions. Trade transactions, as I mentioned in the session previously, it is a current account transaction. So all your current account transactions falls under the trade transactions. So trade transactions, because it is a current account transaction, so it is generally permitted until unless it is prohibited. So the broad framework is all your current account transactions are generally permitted until unless it is prohibited. So recently, like not recently, in the month of January itself, the government came out with the new master regulations on the export and import, which will be effective from 1st of October. So they're changing the entire structure of the import and export transactions. I will be in the next 5 minutes, I'll be briefing on the import and export transactions, what is earlier there and what is actually changing. So first is, if I talk about from the export angle, export, the time frame was 9 months, and now by mistake, so earlier it is 9 months, now also it is 9 months. So earlier, what there was in between time frame, it was mentioned, it was from 9 months they increased to 15 months, but now again the RBI has changed to 9 months. So from the date of export, you have to realize within the 9 months time frame. So for example, if I'm exporting as on today, so from today, from the date of export, you have to realize your export proceeds within the 9 months time frame. If you're not able to realize within the 9 months time frame, you are allowed to go forward with the extension. Extension is allowed for 6 months at a time. There is no maximum cap, but 6 months at a time extension is allowed. Next is the advance. If you have received an export advance, then there is a condition. Earlier, you had to export within 1 year. Now they have changed to 3 years. So once you have received an export advance, within the 3 years time frame, you have to export. Another part, a very important change which is there in this new specific regulation is, if, for example, you have exported, but once you have exported, you are not able to realize that money. And because you're not able to realize the money, the government is saying, because you're not able to realize your money in your exports, first, you have actually lost the foreign exchange for the Indian government. So here, government has said that if you're not able to realize your money, export realization within the time frame, and it is outstanding beyond the time frame, then it will be obligatory on you to have all your future transactions, export transactions, only on advance. It's a very important change. I'll repeat the change again. If you're not able to realize or export within the time frame that I have already discussed, it is remaining outstanding beyond the time frame, then in that case, RBI has said that all your future exports can only be against an advance. That if you receive an advance, then only you can export. Otherwise, you're not allowed to export. It's a very big change that has come into. Next is the write-off. Write-off means if, for example, you have exported and for example, you have exported for 1 crore rupees and you're not able to realize, for example, your realization is only 90 lakh rupees. So 10% of it you're not able to realize. So that you have to move forward with the write-off. In case of if it would have been a domestic transaction, you could have just adjusted in your debit note or credit note. But here, because it's a foreign transaction, you cannot just complete a transaction with a debit note or credit note. You have to comply with the write-off rules and regulations. So what is the write-off rules? It says first, the maximum write-off of a particular invoice can be up to 25%. So what it says that maximum cap of the write-off of a particular invoice can be up to 25% of that specific invoice. But if majority of the case, if a particular company is actually not willing to give us the export realization, they don't actually cut only 25%. They don't give it at all. They don't completely give it the entire money. So what they have said that if your entire transaction, regardless of the amount or percentage, if you're not able to realize it, so for certain specific transactions like quality issue or for certain, if it is you have raised a legal, you have raised issued a legal notice to them, like you have involved the embassy. If there are certain specific transactions, only in specific transactions, if you're complying with that, then only your 100% write-off can also be done. Otherwise, only 25% of the invoice value you can write off. Second condition is 5% or 10%. 5% of your previous calendar year export realized. Whatever your previous calendar export realization is there, 5% of it you can cumulatively in the entire financial year write off. So you have to see two specific restrictions or conditions. First is the 25% of the invoice value. Second is 5% of the entire specific previous calendar year export realized. You can write off in a particular complete calendar year. If, for example, it is beyond 5%, up to 10%, then the power lies with the AD bank. But if it is above 10%, then the power lies with the RBI. So if it is above 10%, then you have to take the permission from the RBI. If the previous calendar year export realized, not export realized 10% below AD bank, above 10% RBI. Next is the import payment. Earlier rules you used to mention that before 1st of October, the rule is that you have to make the payment of the import within the 6 months time frame. That means once you have made an import, within the date of import, you have to make the payment within the 6 months time frame. If you're not able to do it within the 6 months time frame, then you can move forward with an application for extension. You have to apply an extension to the AD bank, not to take the permission from the RBI. You have to apply the application to the AD bank. So AD bank gives you an extension for 6 months at a time. It is not like a blanket approval. 6 months at a time, they will give you an extension. But the maximum limit is 3 years. So 6 months is the time frame. 6 months at a time extension. Maximum cap is 3 years. So this is the existing rule. What is changing after 1st of October? The government has completely changed the time frame. Now what is happening is, if the time frame, the entire import payment time frame is on the basis of the commercial transaction, that is the importer and the exporter, that is the buyer and the supplier. The buyer and the supplier will decide within what time they will be, the buyer will be making the payment. So it can be 1 month, 2 months, 6 months, 1 year, 3 year, whatever is the time frame they have to define in their commercial document, that is the agreement. Basis that the Indian importer has to follow that specific time frame. This is the change that has come up, that will be coming from 1st of October. Small value closures, recently for 10 lakh below entries, the government has liberalized the entire system of closing the EDPMS and the IDPMS entries. Set of provisions are there that if you want to set up your import and export transaction, then you can do it, but it has to be goods to goods, not goods and services. So this is basically the entire framework. LRS is also there. LRS is basically how much remittance the Indian resident can do. This is only for resident individual, not for person resident outside India. How much an Indian resident can make a remittance outside India in a particular financial year. So that is basically liberalized remittance scheme. What does the law say? It says that in a complete financial year, under the liberalized remittance scheme, a person resident in India can make a foreign investment, or can make a foreign remittance up to 2.5 lakh dollars. That is $250,000. That is the maximum cap in a particular financial year. That cap is for the entire transaction. Maybe it can be capital, it can be current, regardless of the current account of transaction, whether it is gift, whether it is for study, whether it is medical, for any purpose, for making investment outside India, for purchasing bitcoins, for purchasing equity shares outside India, listed company, unlisted company, anything. All your specific outside remittance by per person resident in India can be up to 2.5 lakh dollars. If purchasing outside India as a property, that is immovable property outside India, if you want to purchase in Dubai, that is up to 2.5 lakh dollars. So the entire, all the transaction has to be covered under the 2.5 lakh dollar limit. So it can be current account, it can be capital account, regardless of the account of transaction. The entire specific limit is 2.5 lakh dollars. If there is any kind of FEMA specific contravention, then the law simply says, the section 13 simply says that 3 times the amount involved. 3 times the amount involved is a simple, straightforward penalty that the RBI can levy if there is any contravention of the FEMA Act. If the amount cannot be specifically actually understood, then in that case, 2 lakh rupees is the value of the penalty. If it is a continuing offense, for example, there is any kind of delay, then in that case, 5,000 rupees per day is the contravention penalty. So 3 times the amount involved. If the amount is quantifiable, if the amount is not quantifiable, then in that case, 2 lakh rupees. If it is a continuing offense, then 5,000 rupees per day. This is basically the penalty that is there if you are not complying with any of the specific FEMA Act. So this was the entire understanding from the FEMA Act. Next, I have to discuss on the international tax because we have only half an hour. So let me just take up with the international tax, then I'll take up all the questions at the end. So international tax, because if I want to understand, like when we were studying the specific session, we have understood like there are 2 specific ways through which the government is actually regulating their entire transaction. One is from the regulatory angle, the other is from the revenue angle. So revenue angle from the transaction of current account, they generally take from Customs Act as well as the GST Act. But from the regulatory angle, FEMA Act is the major angle. But from the angle of income tax, because here income is also involved. So that is why the Income Tax Act comes into picture. Now, because it is Income Tax Act 2025, Income Tax Act 2025 comes into picture when we have to actually understand the specific coverage of the entirety of the international transaction. So what we have understood from the FEMA in the first slide, same is in the case of income tax. First is you have to understand the residency, because residency definition is different in the case of income tax and in the case of FEMA. I won't go into detail on the definition of it, but residency plays a very important role because on the basis of the residency, you have to define that what specific act or what specific section has to be followed. Next is the source. Source means that can be accrual, business connection, SCP, royalty, FTS. What is the exact source? That is the capital gain. What is the source of income? Next is the treaty benefit. Treaty means the DTAA treatment, that is double taxation avoidance agreement. The Indian government has DTAA agreements with different countries. So you have to see the DTA specific treatment, that what specific benefit is there under the treaty. Next is the permanent establishment, if you are fulfilling the permanent establishment rules and regulations. Next is the beneficiary ownership, because there are multiple instances. For example, in Singapore, there are multiple companies in Singapore which has an ultimate beneficial ownership of China. So you have to see where exactly is the beneficial ownership is going. Next is the MLI, that is the international instrument structures. Basis that, if you have understood the specific rate, then you have to understand the computation of it. Computation means the rate, then whether you have to go for gross up, whether you have to go for deductions, FTC, that is the foreign tax credit, or the foreign exchange. That you have to understand from the computation angle. Basis that you have to comply with either withholding the tax, that is the TDS, filing the forms, returns, transfer pricing, and evidences. So this is the entire structure of the chargeability framework that you as a chartered accountant have to cover under the international tax. So international tax, if I talk about where from the FEMA angle, I've already discussed in detail, like where the chartered accountant's role comes into picture. Here, in the case of FEMA, it is not limited to just the advisory part, but also on the compliance, also on the structuring. So structuring is where not only just the FEMA Act has to be seen, you have to see from the Act of Companies Act, because you have to comply with the Companies Act. You have to also see the Income Tax Act, because when a foreign company is coming into India, they don't just want to understand the Companies Act. They don't want to just have like a private limited company here in India. They want to understand and see what specific taxation structure, what specific FEMA regulations they have to follow, and the corporate structure they have to have, so that the maximum tax planning can be done, the maximum compliances of the FEMA Act has to be done. So the entirety of the structuring has to be done by a chartered accountant as a professional. It is not like just opening a specific private limited company. You don't just have to just file form FC or FCGPR if it is FDI, from FCGPR, and that's it. Your specifically services are over. You have to actually give a comprehensive understanding of to them on what will be the best structure. Plus, I'm not covering that specific topic, but also you have to also give them in detail the report which specific state can be a big advantage for them, which specific state is giving the best possible incentive, best possible infrastructure, best possible workforce for this specific industry. So all of this has to be defined. Then only you are you're ready to actually give a comprehensive advisory or structuring opinion to a foreign company. So as a professional, when we are also advising clients or like multinational clients when they're planning to set up a unit here in India, it's not simply limited to FEMA Act. It is not simply limited to Income Tax Act. We have to see from all the angles on where that specific company will be at a very advantageous position, which specific state, because multiple states have also option of giving like sector specific, company specific benefits. So all of this, from the GST angle, from the customs angle, all of this has to be actually verified. Basis that you come into a final understanding of what is the best possible structuring that is possible. So this is where a chartered accountant roles comes into picture. It is not just limited to just filing the form FC, filing the form FCGPR, just filing the just deducting the withholding tax, just filing the form 15 CACB. No, your role is not just limited to filing the forms. You have to have you should be a complete business solution provider. So your role should be understanding from the best state, next the best possible structure, next if the company is importing into India, what are the best route, either in the complete knockdown condition, the complete product as a whole, complete knockdown condition, SKD form, or maybe as a raw material, any specific custom exemption notification there, GST impact of it. So the entire structuring has to be done basis that the company is actually confident enough to give you the entire work. Otherwise, what happens? They will go to like bigger firms, and they will, because bigger firms has an advantage, they have all their partners in a single specific organization. So your role as a professional, as a small and medium professional like practitioner, should be to have a comprehensive understanding of all the specific laws and regulations. So first we have discussed on the FEMA Act. Next, as we are discussing, is on the Income Tax Act. So Income Tax Act, if I talk about the treaty entitlement, because if majority of the investments from India used to be in countries where India had a treaty benefit, like Mauritius, Netherlands, these countries came in, these countries had a treaty benefits. Because of these treaty benefits on the return on the capital gain, the company used to majorly invest into these specific countries. But because Indian government also know that all of this structuring is only to enjoy the duty-free, tax-free country benefit. So that is why they are changing the regulations of the TT benefit too. Either they're removing the benefits, or they're making it stringent to actually ensure that your permanent establishment is actually in that country. It is not like that you have just opened a company outside India and it is a permanent establishment outside India. It is not the case. There can be a possibility, because there are no employees outside India. All the employees are in India. So all the services are actually rendered from India. So there can be a possibility that the income tax will say, the authority will say that your permanent establishment is in India, and you will be liable to make or the whatever income that you have accrued outside India, you will be liable you will be liable to pay the income tax in India. They can be a possibility. So the structuring whenever there is outside investment, that also has to be seen, that The structuring also looks into picture not just the TT benefit, but also the conditions of the TT. The conditions of the TT can be, first is the TRC, that is a tax residency. Second, and most important, is the permanent establishment. The permanent establishment, there are different kind of risk involved. So permanent establishment cannot be only on the basis of fixed place. It has to be, it can be dependent agents, service P is, there are specific different regulations, construction P also have a different regulation, digital, if there's a, if it is a digital services, then in that case it's a different specific rules. So for individual specific sectors, they can be a different specific rules on the permanent establishment. So until you don't define that the permanent establishment is actually outside India, otherwise the Indian income tax will say that you are liable to make the you're liable to actually give the income tax or the tax on earning that specific income in India itself. So when you're structuring these transactions, you have to actually identify that the permanent establishment is actually that in that specific country. TRC, as I mentioned, TRC is basically tax residency certificate. So if, for example, you want to take the benefit of treaty, so treaty benefit is not just like simple that if, for example, if I give an example, that I want to I want to make a payment outside India for royalty purpose. So royalty purpose, my TT benefit says that rather than, for example, 10%, you have to give only TDS is only 2.5%. So if you're deducting only 2.5% as a TDS, so it is not like you, because it is mentioned in the TT, you are allowed to move forward with an 2.5% of TDS. No, you have to see the conditions of the TT, how the permanent establishment is there outside India. Second is whether you have the whether you have the TRC, the tax residency certificate of outside India, and specifically different TT have specific conditions. Like what specific conditions you have to follow. Basis that only you are allowed to take the benefit of the treaty. So all of this you have to actually see before making the payments to non-residents. So when you're making the payments to non-residents, you have to actually characterize that if it is a good service, royalty, FTS, interest, capital gain, or a reimbursement, because all the different type of transaction has a different type of specific rule. As it is in public, it is in the news that certain there are certain like chartered accountants which have issued form 15 CB of more than 100 crores, 150 crores in a particular financial year. So that also creates a big challenge, because if it's a very important part. Just signing of the form 15 CB is not just the complete understanding of the law. You have to see that what exactly is the purpose of the characteristic of the specific transaction. You have to actually see whether the payment or the tax of that specific transaction is being done or not. Basis that only, third part, the TT benefit, basis that only you have to actually sign the form 15 CBA. Otherwise, it's a very risky to sign as on today, until you don't have a comprehensive understanding, you don't know the complete law, plus you don't know the actual nature of the transaction. It will be difficult for you to actually sign that specific form 15 CB. So first is the characterization of the specific transaction. Next is the domestic law. You have to see whether it is chargeable in India, the source rule, the withholding provisions that are there in India. The withholding provisions, if for example there is talks about 10%, the treaty benefit can be there. The treaty benefit can have a further benefit of maybe 2.5%, 5%, depending upon the country to country. You have to see from the rate, the benefit that is there, the beneficial ownership condition, the permanent establishment condition. So basis the TT benefit, you have to actually see the way through which you have to comply with, like whether you have come up with a rate. You have to see whether you have to gross up. You have to go forward with the lower or nil TDS certificate. Form 14, 145 or 146, that is a form 15 CB is changed to 146 now. So next, you have to file the procedural part to it. For the filing of the procedural part, you have to have the evidence. So TRC, form 41, agreement, invoice, deliverables, declaration, everything you should have. Basis that only you are required as a chartered accountant to sign the form 145 or 146. Otherwise, as on today, it is very difficult or very challenging to actually sign all these specific certificates. So earlier it used to be form 15CA, now it has changed to form 145, 15CB changed to 146, 3CB changed to 48, 10F to 41, 27Q to 144. So these are the new forms under the Income Tax Act 2025, which is applicable from 1st of April. Next is the transfer pricing sections. Transfer pricing, it's a very big area for the Indian chartered accountants. earlier only the big fours were having the advantage of the transfer pricing, but now all the small and medium practitioners are also giving and rendering the services of the transfer pricing. So under the what exactly is the transfer pricing? So transfer pricing is basically when a foreign company is making investment into India or an Indian company is making investment outside India, they have to evaluate because it's a related party transaction. You have to evaluate whether that transaction is following the arm's length discipline or not. That means you have to see the interest rate, the royalty, the dividend, whatever the transaction is there, maybe the service fees, anything, the cost plus markup, any kind of transaction between the holding company and the subsidiary or Indian company and the foreign company which have a relation, they have to follow the transfer pricing. Transfer pricing means they have to evaluate that it is under the arm's length pricing. Arm's length pricing, you have to actually evaluate transaction wise. It is not like you have to evaluate as a company specific. Transaction wise, you have to evaluate. So arm's length is the competition is a very important part. First and important thing is the competition of the arm length. So when you are determining the arm length, now the section earlier it was 92 section, now it has been changed to 161. So competition of the arm length, you have to first define the associated enterprise. Who all are the associated enterprise? After the associated enterprise, you have to define what kind of international transaction is there, whether is there any kind of specified domestic transaction, because they also have to file the form transfer pricing. Next is the documentation part, how the arm's length pricing method has to be filed, how on the what basis the arm's length will be defined, because the basis have to be defined on the basis of the specific just give me a second. So on the basis of the specific on the basis of the pricing methods, you are defined that you are required to define that what specific regulations or what specific methods you have to follow. So this is very important part, because once the method is defined, basis the method, you have to actually transaction wise define that which specific method is best for you. So it can be CUP method, RPM, it can be any method, but as a chartered accountant, you have to actually check which is the best possible method as a company you feel that will be relevant for the organization. So it can be CUP method, RPM method, CPM method, TNM method, PSM method. It can be any method which the chartered accountant think as a comparable option that will be benefit for, that will be best suitable and allocated for the extension volume. That will be best for the specific transaction. So the method, it is not specifically like if I talk about from the method angle, there are multiple softwares that are there in India that the Indian chartered accountant uses, because the benchmarking has to be done. For example, if a company is into the accounting sector, so accounting sector is generally under the cost plus markup. That means cost has to be whatever cost that is there, a markup fees the Indian company will levy, above which extension लेके आगे चल नहीं रहा नहीं, तो above which only they will be the markup has to be defined. So the markup, when they are defining, it is not like you are defining the markup on a random basis. The markup can be defined on the basis of a industry standard. So industry standard, it is not like easy just to Google search and then get it. So there are multiple specific softwares which you can use, basis that you will be able to actually benchmark your specific transaction of the transfer pricing. And also they will be defining the specific software also gives an advantage that the method also can be defined and gives an advantage. The specific software also gives an methods, like which specific method you can use for this specific transaction. So the law doesn't specifically mention that this specific method you have to follow. It is on the basis of judgment. So judgment has to be on the basis of certain specific industry standard. So the standardization you have to use as a chartered accountant, and for that you can use different kind of softwares. Even in the ICAI have tie-up with certain software companies where the Indian CAs can, if they want to take that specific software, they can take it at a concessional rate. like next is the interest limitation, secondary adjustments, and the GAR rules. So here also, where because of the paucity, I'm not able to actually go into deep dive into the regulations part to it. But these are basically ways through which when you are doing the international transactions, there can be multiple adjustments. You have to actually see that the general avoidance agreement, because there are ways through which generally if a foreign company is being set up, it is generally set up for the avoidance of the tax. So you have to see how the specific GAR rules is also being complied with. So when you are complying and formulating the entire corporate structure, you have to not just see a single law, you have to see the entirety of the entirety of different laws, basis that you are able to actually conceptualize the corporate structure of the foreign company or the Indian company. So the if I talk about, or if I conclude the entire specific session, so when you are undertaking any kind of contract, invoice, or anything, make sure starting with, if you want to start with, you can start with the FEMA Act. FEMA Act gives a broader picture understanding on what specific time frame is there, if there is any write-off, set-off, or extension clauses there, that you have to see from the FEMA angle. Next, from the angle of taxation can be how much withholding tax will be there, whether it is under the arm's length price or not. So for that, you have to go forward with the transfer pricing. Next is whether the payment, you're making the payment, it has to be tax deduction or gross up method, what foreign exchange specifically you have to follow, TP, that when you're finalizing the transfer pricing report, which specific method you have to see, what benchmarking you have to mention. So all of this you have to understand from the angle of income tax. So from both the angle from the FEMA Act as well as the Income Tax Act, your responsibility as a chartered accountant is to comply with the entire transaction. So so you have to see from, if you have complied with from the FEMA angle, it is not like you are not required to comply with the income tax. So as a chartered accountant, it's a very big area, is because I have been into practice and working specifically into this area of international tax as well as the FEMA. So the challenges which the companies come up with, or the issues that these companies come up with, it is not simple. So it requires a different level of understanding, all the nitty-gritties of the understanding. But I can just mention, like, because we are ending the session, I can just assure you it's a sector, it's a specific area which has a huge potential, which has a very huge potential for the Indian chartered accountants, because it is not just filing a monthly return, not just filing, or not just fulfilling this, or passing any accounting entries. It is from a broader angle, because here your specific conceptualization of, or the understanding shouldn't be not be limited to a single act, but from the entirety of the structuring. Then as I mentioned, because once a company outside India is making investment into India, they just don't see the acts, they also see the favorability. So you have to see the marketability, if it is marketable or not, your product, that product is marketable with specific economy, because in India, all state has a different economy. So which specific state is beneficial for him? Which specific state has a major advantage from the infrastructure, from the angle of incentive, from the angle of like people, from the angle of workforce. Next comes the FEMA, next comes the income tax. So when you are advising these kind of multinational corporates, you have to have a holistic understanding. And that is where, because it's a complex part, that is where a chartered accountant comes into picture. Otherwise, if it's a normal small kind of transaction, now AI is also very strong, and each and every day AI is also gaining its specific understanding of different, because it's coming up with different case laws, it's coming up with different questions from us only. So until unless it is a complex transaction here, then only the client also actually gives a value addition fees. So that is why, as because the objective of the entire session of today was to have to give a broad understanding on how Indian chartered accountants can come into the specific acts, or render the services in this specific act of FEMA and the international tax. So I think I have covered the broad coverage of the specific transaction. Now, if anyone has any specific questions, then I will take the questions. Otherwise, we'll close the specific session. Priyaji, if there are specific questions, you can.
Sure. Just 1 second, sir. There is this one question, whether export can be made only after receiving advance from the importer is applicable, even if the exporter fails to realize only one export in the full year.
So a
Release.
very
Only made
important
one
question.
export in the full year.
That is a very important question that you have asked. So here, if I talk about on the regulation is not actually bifurcating it. It is not mentioning that. It is clearly mentioning that if there is outstanding exports and there is the extension is not being given by the AD bank, then you have to all your export has to be in advance. But because RBI is now moving up all its responsibility to the AD bank, so AD bank will be coming up with the SOPs. So in the next in the month of September itself, you will be able to see that there will be multiple SOPs by all the banks. There you will get the complete picture. But because as you mentioned, it is a practical challenge. Even if, for example, you're dealing with thousands of clients, maybe hundred of clients, if you're not getting a remittance from a single company, so for all the 99 companies, it is mandatory for you to get an advance. That will be a big procedural challenge. So from my understanding and my discussion with the AD bank currently, they are of the opinion that they will do only for that specific party only, not for the entire a specific transaction. For that specific party they will be mandating. But because the RBI has given the power to the AD bank, so AD bank is yet to come up with the specific policy. After the policy only you will be getting the complete understanding. But from my understanding, it will be limited to only that specific company who has actually not given you the remittance.
Right. Just a second. As an Indian business, as the Indian businesses increasingly become global in cross-border transaction, become part of a mainstream business activity, do you see FEMA and international taxation evolving into one of the major specialized advisory domain for CAs?
Definitely, it can. It is like actually earlier, if I would say, there were hardly any chartered accountants in this FEMA, and this international tax used to be because it's a chartered accountant field only. But FEMA Act was majorly ruled by the lawyers only. Even if like especially the ED also, all the ED proceedings are generally through by the lawyers only. But now the trend is changing. Now multiple CAs, what I have also practically seen, multiple CAs have started practicing into this area. But because if you are belonging from a tier 2, tier 3 cities, there can be a possibility that you will not be coming across these specific transactions in your like regular time frame, regular day-to-day life. But because now world is becoming one, it is not like you are limited to only your tier 2, tier 3 city. You can render the services by sitting in a tier 2 city or tier 3 city and going render service across India. So that is why if you have an advantage, if you take a holistic understanding of these specific acts, you will I can assure you that you will be having a very big specific role in the near future.
Right. Basically, it is mentioned if an Indian resident received income from a foreign asset, what are the key taxation and reporting considerations, and how should the CA advise the client?
So foreign asset can be of multiple types. It can be if you have made an investment in equity, then you will be getting the return from the form of dividend. It can be if a loan is there, then it can be interest. If you have made an investment into a property outside India, then you will get a rent out of it. So for multiple specific transaction, there are specific conditions to it. And as I mentioned, because if it is a dividend you are receiving in India from if you made an investment outside India in an equity space and you're receiving a dividend from that company, in that case that specific company will actually like when they are making the remittance, they will be deducting a tax, that is a withholding tax. That withholding tax bases the DTAA provision. You can either take the DTAA provision benefit, and you can take the complete foreign tax credit in India when you are filing the income tax return in India. So the double tax avoidance agreements clearly mention that the one income should not be taxed in both the countries. So if that country has charged the tax, so Indian government will give you the equivalent amount of foreign tax credit in India. So it will be added in your specific income, or there are multiple ways through which the taxation is calculated. So either it can be added in your income and the credit is done, or it is not even added in the income. So it is all dependent upon the type of transaction and the DTAA specific provision.
Right. Um, What certification, technical skills, or area of specialized knowledge would you recommend to members who want to build a career in international tax and FEMA advisory?
So from the FEMA angle, if you want to, like there's a specific CA, like specific certification course by the Committee for Commercial Law. You can do that. That will give you like at least a brief understanding. Basis that you can start reading the act on your own. And if you don't, if maybe your time doesn't allow to go forward with the entire certification course. So as I mentioned, what you can do is you can start reading the master direction rather than reading the entire rules, regulations, directions, FAQs. Don't because that will be a complicated thing from the initial angle. What you can do is you can start reading the master directions, take a holistic understanding of the specific transaction. After that, once the transactions comes by your way, maybe a client comes into and asks you a transaction, then you can deep dive. Or if you have sufficient time, then you can deep dive the rules and regulations, because you would be requiring the entire knowledge, because once you are doing the transaction, you would be requiring the entire knowledge of the rules, regulations, and the directions. But to start with, because to start initiating or the interest into the subject, you can start with the master direction. Then you can read the entirety of the rules and regulations. In the case of international tax, similarly, there are certification course by the chartered accountants that you can do. And also because international tax, a part of it is similar to the direct tax. Certain kind of additions are there. So that is still where a CA can actually read and get a practical understanding of it. But because FEMA, they've actually not seen, so that for them, you have to start from the scratch.
Right. This is the last question that we have now. If a foreign investor proposes to invest in an Indian company, what should be examined before the transaction is structured and from both FEMA and taxation perspective?
So as I mentioned, if a foreign company is planning to make investment in India, if your answer is, if a question is only limited to FEMA and international tax, first thing you have to define is the sector, which specific sector the company is actually making investment into. Basis the sector, you have to actually see whether it is under the automatic route or the approval route. If it is under automatic route, then in that case, there are not much challenges. You have to file just Form FC, FCGPR, and different specific forms, that are the annual forms. That is from the angle of the FDI. In the case of FDI, because there are no end-use restrictions, you can use the money for any purpose, either for manufacturing, either for purchasing any property and using it as a manufacturing premises. You can use the money for any purpose. There are no restrictions on the end use. But make sure that it is used for the business purpose. It is not used for any personal purpose. So because there are no end use restriction, they are not meant any kind of sectoral challenges to it. So you will be easily able to comply with the FEMA regulations. From the income tax angle, you have to see first the structuring on what will be the best way. It will be a private limited company, limited company, LLP, or what will be the best way. Next part is how the specific investment has to be there. It has to be individual investment or investment by a company. If it is investment by a company, then in that case, what specific, either they are into manufacturing or service-based sector. If it is service-based sector, then you have to see if you are like basically having a back office in India, so you have to have a cost plus markup mechanism here in India. Basis that you have to get the transfer pricing report. So you have to actually do the transfer pricing. Basis that transfer pricing, you have to see what has to be the cost plus markup, the markup to be there in India. So all of this specific angle you have to see when a complete understanding or comprehensive structuring you will be doing. If, for example, you are in sectors where regulation, because if there are a certain sector that are regulated, that is where the complexity arises, and that is where the real role of chartered accountants comes into picture. For example, if investment is coming into e-commerce sector, e-commerce is a very regulated sector, and we have assisted in the past multiple companies in the e-commerce. So we have seen in the e-commerce like how nitty-gritty of individual wording can have a bigger impact in the complete corporate structuring. Like even Zepto, like if I don't know if anyone is following, Swiggy also has recently changed its specific structure from now, earlier it was foreign owned to now Indian owned. Now recently last week itself they changed the structure. What is the reason? The reason is only to comply with the FEMA Act. Now what they can do is, because it's an Indian company, they are eligible to do certain kind of activities that are allowed under the FEMA Act. So there are certain sectors which have different complexities. there the real challenge comes into. That is where the role of CS comes. But if it is a sector where it is under the automatic route, there I won't say it's very easy, but definitely in comparison it is easy, because you don't have to actually you don't have to do a comprehensive or a complex structuring has to be done. You have to just comply with the laws and regulations, and you are okay with the specific compliances.
Perfect. Thank you so much, sir. Thank you for taking out your valuable time and giving us this webinar. Thank you on
So,
behalf of all the PDC
sorry to
team
interrupt you,
and
ma'am. I've
development.
also mentioned in the screen my mobile number and the email ID. You can note it down. If anyone has any questions,
Right.
and I've also, you can connect me on the LinkedIn too. If anyone has any questions on the income tax, on the international tax, on the FEMA, on customs, indirect tax, any specific limit in the cross-border investments or the transactions, you can anytime message me or email me. I'll make sure your specific queries are answered. And
Done.
let me
Thank you
change.
so much,
This is
sir.
the
Thank
number.
you. Sure.
Thank you so much, ma'am. Thank you, the committee, for
Thank you so
inviting
much,
me,
sir.
giving me this opportunity to discuss on this topic. Thank you, everyone, for the patient
Thank
hearing.
you.
I hope I justified the time and completed
You
on whatever
certainly
you
did.
had. So thank you so much, ma'am. Thank you.
Thank you, sir. Mani, sir. Yes.
Shall I leave, ma'am?